I'm going to do another quick update on the crash that's in progress in the stock market. Um, I've been warning about this for a while, and I got several emails from these trolls that uh, you know um, berating me for the market not having crashed when we were in this zone here. Of course, those trolls are nowhere to be seen now. Um, Markets, they run on their own time frame. It doesn't mean just because it doesn't happen when you want it to happen doesn't mean it's not going to happen. When a market gets stretched this far above the long-term moving averages, and it's this late in an intermediate cycle, there's really only one outcome, and that is some kind of a crash or mini crash, because the correction has to be compressed into a short period of time. So there was never any doubt that this was going to produce some kind of a crash event. Now, I will qualify that. There is one time where this doesn't happen, and that's during a final bubble phase in a bull market. But as I've said many times in the past, I think it's too early for that. We're only, um, 10, 11 years into this bull market, and these secular bull markets usually last anywhere from 20 to 25 years. The innovation cycle is still fairly young. We're not seeing signs of extreme excess. We don't have 1,000 companies all jumping into the artificial intelligence sector. Many of them with no chance of ever producing any kind of a profit. We're not seeing that kind of behavior that signals a bubble. So, I never really thought that this was going to transition into a final bubble phase, just a mini bubble. The QE that the Fed started in October to try and save the repo markets just triggered this really long and aggressive bull market run, and they set the stage for this crash event to occur. Today we've got confirmation that the daily cycle has left translated, and by that I mean this was a daily cycle low right here. We've rallied out of that daily cycle low, and then now we've come down and broken below it. So all that means is that we're making lower lows. At some point here, we should have a bounce, and probably a very convincing bounce. Um, and buyers, that's where the buyers will come in, and they'll be too early, and then the market will get short-term overbought, and then it'll roll over, and we'll get our second leg down. So this is what I'm talking about. We get the first leg down, the A wave, a bounce, and then a C wave decline. Now this can unfold in more than just three waves, but there is almost always some kind of an counter trend move at some point, and then the market um, rolls over and makes a lower low. So it'll make a higher high, or sorry, a lower high and a lower low at some point. I was a bit nervous that the plunge protection team was going to be able to rescue this. They had the market up about 28 points in the pre-market, but as I said yesterday, all the money printing and all the market intervention still is not going to stop the coronavirus from continuing to slow down the global economy. And remember, we had a recession during the last secular bull market in 1990. So a recession during a long-term bull market is nothing unusual. I would say the odds are probably almost 100% that we'll have at least one during this long-term bull market. And this is a potential spot for it to occur, since we don't have the typical large spike in energy prices that usually triggers a recession. Um, there is, I will admit, there is a possibility that this time a recession could be triggered by just a general pullback in the global economy driven by fears of the coronavirus. I mean, it's already shut down a lot of production in China. That's the second biggest economy in the world. There's got to be an effect from that, and it's starting to spread in other countries throughout the world. So that this has the potential to um, cause at least a mild recession. And so uh, this should, barring the plunge protection team's ability to, stop this or um, make it a lot more erratic than it would be naturally. The natural course would be for this to just continue to crash and maybe come all the way back down to the 200-day moving average on the first leg down. That would imply that we're going to have some really nasty, scary days this week. And then we would ideally, almost certainly, get a bounce off that 200-day moving average. That would be our B wave counter trend move, and then a second leg down. And I'll switch this over to the weekly chart. If we are about to have a mild recession, then this intermediate decline would probably form the true 4-year cycle low. And as I've said in many of my past videos, this was right now, this is looking like the 4-year cycle low. Problem is it came really early. It wasn't even 3 years into the cycle, which makes me a bit nervous that maybe we've got another one of these scary things coming in the normal timing band, which would be early this year. That would be the normal timing band for the 4-year cycle low. And if that's the case, then over the next 3 or 4 weeks, we're going to see some really big, nasty candles, red candlesticks on this chart, and we could come all the way back down to retest this 200-week moving average. I don't know that the odds are great of that. If we were to have a mild recession, then I would say the odds are very good that happens. But we'll just have to see how this plays out over the next couple weeks. We're only 16 days into this daily cycle. We convert back to the daily. We're only on day 16. The daily cycles typically run 35 to 45 days from bottom to bottom. So we've got, potentially another 15 to 20, even 25 days before this bottoms. So plenty of time for the first leg down to get extremely oversold, push the McClellan oscillator to very oversold conditions, bounce, and then a second leg down. So we'll see how that plays out. And next I want to look at gold. And I'm going to start with the mining stocks. So this is how we are trading this. If we do have a mild recession, it's going to trigger a lot more money printing, more rate cuts, and we're going to, as I keep saying, that's almost certainly going to cause inflation in the years ahead, and I think gold is already anticipating that. So this is how we played this. We were waiting for some sign that the miners had broken free of the bullion bank manipulation to keep the miners in silver suppressed. This big candle was our confirmation that the miners had broken free of that suppression. So this is where we bought. So now we've got, let me widen this chart just a touch. So you can see yesterday the mining stocks came up here to test the baby bull high. This is an obvious major resistance zone, one that's probably not going to get broken on the first attempt. So not unusual at all that price would pull back from that spot. So here's our entry point, and this is our stop. We've got a break-even stop now, so we can be patient. If this were to come back down, then we would stop out at break-even and we wouldn't lose anything. Now what we're waiting for is a breakout above this baby bull high. And let me show you that long-term chart again. So this is kind of what we're waiting for, a breakout from this baby bull high. Remember the rule, the bigger the base, the higher in space. So a breakout above this baby bull high is going to ignite a huge rally that I think will ultimately is going to retest these highs. But during this particular intermediate cycle, I don't think it's unreasonable that a breakout right here could take the GDX back to this resistance zone here around, between, let's just call it $38 and $40 right in here. So this is what we're kind of waiting on. We've got a nice cushion on our entry. Our entry was down here. We've got a break-even stop so we don't lose money. And now we're just, patiently waiting for a breakout. When it comes, then we get aggressive again in anticipation that price will move very rapidly from this breakout to this next resistance zone. So you can see a much better strategy being a contrarian, trying to pick these bottoms, buying on confirmation here, as opposed to how I suspect most people, they didn't trust this breakout. They waited. They probably bought here or even bought yesterday, and now they're underwater. And this is why a lot of people lose money, even though they have the correct trade on. They are long in a bull market, but their emotions prevent them from buying low. They end up buying high when their emotions give them, the all clear, and then that's typically when a pullback occurs. And yesterday's sentiment, short-term sentiment, had gotten too bullish, excessively bullish in the metals and in the mining stocks. So, this is not unanticipated. We were kind of expecting that this resistance zone would stop price at least briefly. So we've got some decent profits. We've got a protective stop, and we're waiting for a breakout. And once the breakout comes, then I think there's big potential, at least up to that next resistance zone.